Good morning and good afternoon, everyone. Thanks for being with me here today. I'm with James Rooney, who is a crypto trader and investor. Thanks for being with me here today, James.
Hey, Jarrett, pleasure. Looking forward to talking.
So, James and I, for context, we're neighbors, and that's kind of how we originally got to know each other. But James, you do some really cool stuff in crypto. Can you give us a little bit of a background as to how you got into this space, and then what is your involvement in the space here today?
I was initially a solicitor or lawyer back in England, and I came over to Canada in May 2012 to do an MBA at UBC. After the MBA, I worked for Pepsi and then a few startups. In 2016, my wife and I relocated back to London. And I worked for a startup in London for about 6 months, and then got into crypto full time at the beginning of 2017. I'd actually already started investing in and learning about crypto in mid 2015 after a friend of mine on the MBA program started to learn a little bit about Bitcoin and wrote a dissertation on it.
Mm,
So again, since the beginning of 2017, I've been full-time crypto trading, investing,
yeah.
and I mostly just manage my own money as well as a little bit of family money.
Yeah. Okay, that's great. So 2017, was this during the 2017 bull run that you got in?
Well, yeah, I mean, as I said, I got in a little bit earlier,
Okay.
sort of mid 2015, so I
Yeah.
already had a little bit of crypto before that particular bull run started.
Yeah.
But yeah, I was totally engaged from, if not towards the end of 2016, then the beginning of 2017, then obviously the bull run topped out around about December 2017 to
Yeah.
January 2018.
Yeah. That's when I got involved, unfortunately.
Well, everybody needs to go through their first bull and bear cycle.
Yes, the late 2017 was when I jumped on board. Okay, so can you give us a bit of context when you say like you're a trader and you manage a fund? What does that actually look like day to day?
So mostly what I do is actually read and learn and try to stay engaged on what's happening, both on something called crypto Twitter, specifically crypto Twitter. And crypto Twitter is the same kind of thing as fin Twitter or financial Twitter, except the people that you're following and engaging with are either sort of crypto personalities, pseudonymous people, or people who actually reveal themselves.
Hmm.
So that's one thing I tend to do most days, and I'm on Twitter probably maybe an hour or two a day, and then I read a
Wow.
lot of research reports, and look at various different on-chain activities.
Mm.
I don't actually trade that frequently unless we're either sort of deep into a bull market or deep into a bear market.
Hmm.
Mostly what I do is I'll have a pool of crypto which I just sort of hold for the longer term, and then as and when market conditions allow, I might collateralize some of that to be able to get additional funds without selling the crypto I have,
Mm.
and reinvest that back into other projects, and then hope to, as best I can, try and time the market to get in and out.
Mm. Okay, that's great. So you're not sitting at your computer day trading. You're
Not
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 like,
really, no. I mean, there are times when I'm pretty active, when I'll trade multiple times a day, but generally speaking, I'm generally passive, and I'm
hmm.
mostly just kind of collecting information, both technical and sort of social or sentiment orientated.
Okay. And when you say crypto Twitter isn't like an official thing, is it? Is it more just like the people you follow are into crypto? Is that what crypto Twitter is?
Yeah, it's not it's an unofficial sort of subgroup within Twitter. Obviously, these people are crypto traders or
Hmm.
investors. They probably have multiple different Twitter accounts, one of which is specifically relating to
Hmm.
cryptocurrency. So they'll post like memes, or they'll post their thoughts and comments on different projects or technical price action, where they think we are in a cycle, like they'll ridicule different things that might be happening within
Right.
crypto. But anyway, everything they do is specific to
Yeah.
cryptocurrency. They don't necessarily really talk about anything other than cryptocurrency, which
Yeah.
is why it's sort of crypto Twitter. In other words, it's on Twitter, but it's all sort of crypto orientated
Yeah.
content.
Okay, that's great. That's excellent. So when you're reading these pieces of information, so Twitter is one resource for you to find information. What other places are you looking? You said you read reports. Where do you find these reports?
So there are several different types, some paid for, some free.
Mm-hmm.
The free ones would be Defiant,
Mm-hmm.
Bankless,
Mm-hmm.
uh, and then some of the paid ones would be Delphi Digital,
Mm-hmm.
Look into Bitcoin, which is it's primarily free, but I think for something like $5 or $6 a month, you can receive both sort of market updates in the form of a brief report, and they'll also send you technical indicator alerts when different things happen on chain, at least to Bitcoin. So that's sort of my primary go-tos. I'd also recommend looking at Nansen.ai
Okay.
and Glassnode as well, and then they're sort of more on-chain or technical analysis for what's happening on the Ethereum or Bitcoin blockchains.
Okay, that's great. And so you both pay for information and get information free. How important is the paid for reports that you're reading versus the free stuff?
They both serve different purposes. I think the difference with the paid reports is that the information provided is certainly a lot more detailed. Like, for example, if I've heard of a project getting started on Ethereum or Avalanche or I guess at the time Terra Luna when it existed, I can look into it myself, which will take me a certain amount of time to do, and I might not have the ability to be able to find everything that these analysts could have because either they have more resources or they're just technically better than I am. So to speed that process up and to make sure I don't miss things, Delphi will dig deep into particular projects, and they'll produce monthly chart books on price action. They will attempt to provide, in inverted commas, alpha in relation to projects or happenings on chain which they don't think anybody else has found.
Right.
And then they'll provide their own commentary on what they think that means. And then every week they'll have basically like a conference call, like they might have in traditional finance. So if you're an analyst at Goldman Sachs or any of the other large banks or financial institutions, those people will sit in on analyst calls every week where individuals from different companies will talk about their earnings and that kind of stuff. Whereas in this instance, it's not so much that you're hearing about how specific projects are doing from these project leads. It's just that the analysts at Delphi will talk about what they're seeing in the market in, for example, decentralized finance, NFTs, or the sort of broader macro environment, both in crypto and in the wider economy.
Okay, that's great. So let's kind of dive into some different aspects of crypto. So we hear this term DeFi. Can you give us a bit of background and explanation, a bit of definition and context around what is DeFi?
So DeFi is decentralized finance. Decentralized finance initially started off on the Ethereum blockchain. I can't point to one specific individual that I would say, yeah, this person created DeFi. But certainly in the earlier days of decentralized finance, there was one individual who stands out, and that would be Rune Christensen from MakerDAO. So MakerDAO, as far as I can recall, was started towards the end of 2014. And that's a platform whereby you can collateralize your Ethereum, and in exchange for collateralizing your Ethereum, you'll receive a DAI token, which is a decentralized stablecoin.
Can you just explain collateralization?
Sure. So you will deposit your Ethereum into a smart contract, in other words, a self-executing contract on the Ethereum blockchain. And in exchange for depositing, and in this instance, essentially locking up your Ethereum, you'll receive a certain amount of a US dollar pegged stablecoin. Stablecoin is just a cryptocurrency, which again is pegged to the US dollar. And the amount of the stablecoin that you receive, in this case DAI, is dependent on what your risk tolerance is. So the more risk orientated you are, the more DAI you'll receive. However, if the price of Ethereum, which is your collateral, turns down, then your loan to value ratio, in other words, the amount of Ethereum you have relative to the number of stable coins or DAI you're taking out, reaches a higher level, you will get what's called liquidated, which means that they will sell that portion of Ethereum which you've deposited in order to cover the loan which they've made to you in the form of DAI, and then they give you back whatever Ethereum is left, which hasn't had to be sold to meet the loan obligations.
Yeah. Okay, that's great. And so can you explain what is the difference between that and staking? Or is that staking, or what does that really mean?
So it's not staking. So staking is normally used to secure a blockchain. So You may or may not know that I think it's now slated for mid-September of this year. Finally, Ethereum is due to transition from proof of work to
Mm-hmm.
proof of stake.
Mm-hmm.
And there are several other blockchains which are already on proof of stake. And in order, so if you lock up a certain number of tokens or Ethereum, for example, you get rewarded for that, and you get paid an interest rate in those same tokens,
Mm-hmm.
and you're getting rewarded because you are not using your Ethereum, and you're essentially protecting the security of the blockchain by locking up your tokens.
So would that be similar to a term deposit in the bank?
Um, I'm not entirely sure, to be honest. I think with the term deposit in the bank, you're, for starters, getting a very small rate of interest
Mm.
because the bank is unlikely to be unable to pay you back in that respect. Whereas in this instance, you're getting a much higher level of interest because there's a risk that something might happen technically on the blockchain where you could lose the Ethereum or any other token you've deposited.
Yeah.
Um, and it's not like you're depositing for a fixed term as you would with a term deposit. You can deposit or stake for as long as you want to,
Right.
and then release it. Although again, in the case of Ethereum, at the moment it's possible to deposit your Ethereum and stake it. There is no defined period that you're staking for because you only get your Ethereum back once the transition takes place. But on other blockchains, you are able to deposit your token, get a staking reward, and you can close that down and get your token back whenever you want.
Okay.
And then the interest rate that you receive from staking is sort of annualized.
Yeah. Okay. That's great. So sometimes we see in the world of DeFi something called lending pools. How, kind of in the context that you've laid, is around staking, and how can we engage in lending pools, and what are lending pools?
So lending pools are where you deposit your cryptocurrency in exchange again for a certain amount of interest.
Mm-hmm.
And when you deposit your cryptocurrency, other people will take it out and borrow it.
Okay.
And in exchange for borrowing it, they will in turn pay a certain amount of interest. And for decentralized finance, there isn't really much in the way of a spread, in that there isn't much of a difference between the amounts that the borrowers pay in interest and the
Yeah.
amount you receive as a lender.
And why is that? Why is there such a narrow or non-existent spread?
Because the nature of decentralized finance is that you haven't got a group of individuals who are required to be intermediaries between you as a lender and someone else as the borrower. So you don't have any overheads in the form of salary or leases on premises or equipment to have to pay for. So as long as the code is good, and honestly, it's not always good, so there are definitely risks. But in theory, as long as the code is good, and the smart contract is such that it will self-execute based
Yeah.
on whatever that code says, so there really isn't very much for any intermediary to do.
So this disintermediation allows for much more efficient of movement of resources and allocation of resources, I guess, then.
Exactly. And the other thing I'd say is, in addition to it being efficient, it's also transparent. So the advantage of it being a smart contract on a blockchain is that if you know what you're looking at, everything is completely visible. Whereas if you're involved in borrowing and lending in the traditional financial world,
Mm-hmm.
it's quite opaque, and you're reliant on trusting the middlemen to get you your money back,
Yeah.
and B, that they're not doing sort of things that will result in you never seeing that money again.
Yeah. Okay, that's great. Other terms that we hear about is leverage farming or yield farming. What do these things mean?
So yield farming was popularized in the so-called first DeFi summer, which was in the summer of 2020.
Mm-hmm.
And essentially what it means is that you will deposit your Ethereum or stablecoins on an Ethereum dApp, or decentralized application, which is a project built on top of Ethereum.
Mm-hmm.
And in order to obtain liquidity, these different applications or protocols will incentivize users to deposit Ethereum with very high interest rates. And the farming part is that, 1 week you can deposit your Ethereum on a particular application, which pays you an annualized rate of 45%. And that sounds crazy, but I mean, at the time, it really wasn't. That was actually on the lower side. And then all of a sudden, you come across another project which you like, and again, importantly, you believe is safe,
Yeah.
which is not always the case or wasn't always the case.
Mm-hmm.
And so you'll immediately just take your crypto out, your Ethereum out, or your stablecoin out, and you'll move it on to the next application, which is paying you a higher interest
Right.
rate. And you'll just keep jumping around
Yeah.
or yielding these different interest rates
Yeah.
according to the application, which generally speaking pays you the highest amount. There are some which will bind you for a short period of time,
Mm-hmm.
either 7 days, 2 weeks, or in the longer cases, 30 days. So you have to make sure that A, you trust the platform, and I mean, theoretically you'd have to trust the code too, but
Right.
the vast majority of participants won't be able to understand the code anyway. So you're trusting the participants who have created the application, and then it has to be an attractive enough rate of interest that you're prepared to lock away your funds for that 7, 14, or 30-day period.
Do you know how to read code?
Not really. I mean, I know at a very basic level. I tend to when I did I don't yield farm at the moment, but when I did it in 2020 and also in the summer of 2021, I only really used projects which had individuals which were well established and I felt that I could trust, and which people that I trust in the form of the research reports that I was mentioning before, those kind of analysts and authors had validated. And the disadvantage of that is that you're receiving a lower rate of interest for these more trusted and secure platforms. But I mean, if I felt that something, although seemingly attractive in the terms of interest rate that it paid, was risky because I can't read the code well enough, or even at all in the case of Solidity properly, it just wasn't worth the risk to me.
Yeah. Did the individuals that you follow and trust encourage people to invest into Luna or any of the projects around the Luna ecosystem?
They did actually, and I did it myself. So I was quite heavily invested in Anchor Protocol,
Okay.
Which was the lending and borrowing application on top of the Terra Luna blockchain.
Mm-hmm.
And for those that don't know, Anchor Protocol was made famous because it paid a fixed and consistent interest rate on an annualized basis, 20% or 19.97 for most of the time, paid in the Terra stablecoin for people who would deposit the Terra stablecoin on that Anchor Protocol. And it was the same as any other lending and borrowing protocol in that, some people would deposit in exchange for this, in inverted commas, fixed rate of roughly 20%, and then others would borrow. And there was a fairly significant difference in the amount they were paying out, namely 20% to lenders, and the amount that they would charge borrowers. And I think the difference was anywhere between sort of 5 and 10%, and that was supposed to be subsidized by the Luna token, which is the governance token of the Terra Luna blockchain. And so the theory was that they would sell down the Luna token in order to make up the difference in the cost of the borrowing and lending interest rates. And again, because as Jarrett just mentioned, I followed and trusted individuals who essentially validated it in terms of using it themselves and said that, as far as they can tell, it seems like a decent deal. And I was lucky. I mean, I had substantial exposure to Anchor, and I took out my deposit, which wasn't locked. You could take it out whenever you wanted. About 6 weeks before it all went down. So I was actually in there for about 4.5 months.
Oh, wow. Okay. But you pulled out in time, unlike many, many other people.
Yeah, I know. Some people got very badly burnt, both with the value of the so-called stablecoin, which went down something like 90-odd%, and then just even with the value of the governance token Luna as well.
Yeah. That was a fascinating story to watch unfold. James, this has been really interesting and helpful. I think you have such a good understanding of, kind of like the fundamentals of DeFi, which is great. And so I really appreciate you sitting down and chatting with us, understanding more about DeFi, lending and staking, how you do your own research, I think is really important for us to understand as well. So we're not investing into projects blindly just based on hype or a meme or whatever it is. I think that's really helpful. I appreciate your time with me today.
No problem. Oh,
Go ahead.
Okay, I was going to say, I would say one more thing. And again, for anyone who's been paying attention to cryptocurrency recently, you may have heard about the failings of Celsius, which is a centralized borrowing and lending platform, even BlockFi as well. These are all centralized platforms, and in the case of Celsius, they filed for Chapter 11, and they essentially are bankrupt. BlockFi was saved by a large exchange called FTX, but they were also in significant trouble. But the main decentralized finance platforms, with the exception of Anchor, all performed really well. Certainly those on Ethereum, Maker, Aave, everything worked as it was expected to. So I think that despite the turmoil that's taken place recently, DeFi actually put in a really good showing.
Yeah.
Which is promising for the future.
Yeah, absolutely. That's really good. That's a great note to end on. Thanks so much, James.
Yeah, sure.